But what was interesting in that dynamic is my thinking was, once I've already opened the door with you and you trust me, then I want to get the phone call when you want something else. Because what was Rainford talking about, not only from the operational side, all of these are the fundamental factors that you better have your house in order to attract the relationships that you want. But at the end of the day, there has to be a trust factor. One of the things that we did, it's a bit of a sidebar, when we were first, we have offices in Copenhagen, Denmark, and we now have a franchise office in Sweden, just opened one in Norway, and also an office beginning in the UK, specifically for European distribution of the strategies that we've amassed over a period of a couple years. In doing that, I remember first going one time, and basically, as Rainford was talking about, there's plenty of data services that allow you to put your data securely out on the web. One of the things that we did is we went out, and the partners of the fund, we had our credit records. Basically, everything that you could want to know about us, we actually had up on a screen in front of all of the attorneys, lawyers, accountants, and the potential investors, and they were floored because purely from a cultural perspective, pardon my French, but you wouldn't bare your soul, for that matter, that quickly. But what I was trying to do was to bridge the gap between you don't know me to you can absolutely trust what it is that I'm saying. So how do we translate that to the everyday emerging manager? To one, garner that trust, get the momentum that they need to build assets. One of the ways that we started doing this is not unlike what Rainford was talking about, is looking at, in our manager selection process, not only the operational aspects and the qualitative factors that you have to deal with there, and also on the investment side, the quantitative factor that you have to address there. And we all know that you can look at every Greek letter in the alphabet and come up with the risk metrics that most people are using once you do the analysis on the investment side. But taking the operational side a little bit deeper, we started actually quantifying all of the pieces of the qualitative information and bringing that into a whole scoring methodology that we can, one, seek to pull as much subjectivity out of the process. When I put my personal information up on that screen, and I know it's a bit of a gross example, but in reality, what I was seeking to do was bridge trust very quickly. And by doing that, what I was basically saying is that here I am, this is what we're about, I've got nothing to hide. By doing a quantitative methodology both on the investment side and on the qualitative aspects of operations, you're again pulling your own self out and allowing somebody to view from the outside looking in just a little bit differently. So what we're really getting at, and I think Rainford touched on as well, is what's differentiating you from the other managers in the marketplace? What is it that you're really doing? A lot of people talk about their strategy. Well, my strategy is different. Rainford touched on it. Well, how are you really creating alpha? If you can't answer that question, it's a fundamental question that you have to answer. But even after all that's answered, all the numbers are done, everything has gone through, it comes down to the character of the individual, and you had better be saying all the things that you said all along, both in print and verbally, they should all be congruent. And that's easily said, but much more difficult to reproduce again and again and again and again. Like Rainford touched on, sometimes things change. Your PPM changes. You have to do an addendum. God forbid that you start out one way and you don't tell somebody that there was an addendum that was done or a side letter agreement that gives most favored nation status to a particular investor, and you happen to miss that. Interview's over, you're dead in the water, you're not getting any allocation. But having the ability to, one, put that information out there in a clear and concise way, pull the subjectivity out of it from some sort of a third party looking in this case, whether it's using some auditing firm, or we've been working with a national organization that does hedge fund solutions from beginning to end. And some of our discussion has been around actually certifying hedge fund managers on their transparency. But doing that in a level system, so that not unlike the CFA, where you would have certain levels of certification of meeting certain criteria, an emerging manager is not going to be able to complete a SAS 70 certification day one. You're looking at some significant expense when you're a manager trying to get out the door. But there are ways, I believe, that you can create that transparency and trust early on in your developmental process as you're seeking to grow assets. So hopefully that makes a little bit of sense. and I'm more than happy to answer any questions that you have and share my experiences of banging my head against the wall trying to get assets in the door and some of the unique things that we've done. So thanks for letting me share with you tonight. Yeah, I will. If I understand the question correctly, it's talk a little bit more about the system of actually pulling the subjectivity out of manager selection. Okay. Part of what we did is look at, again, if you look at the investment analysis, you know that's already in a quantitative basis, so pretty much we can remove that from the system. When you look operationally, there's a lot of qualitative information there that has to be addressed. Now, initially in the scoring model, you're going to have some subjectivity that's going to come in, but you're trying to create some level of generalizations that when you move away from the process, they're repeatable. And they're repeatable based on whether someone meets a certain standard or not. For instance, one of the ideas that we had from a qualitative scoring standpoint is we actually score a fund administrator, auditor lower than the fund administrator. So, well, why would you do that? An auditor is a very important component of your transparency, et cetera. Well, in our opinion, you should already have an auditor, and they should be a quality auditor. It's kind of understood if you want a serious allocation. In our opinion, having your fund administrator be extremely far down the spectrum as far as being arm's length and third party is much more important because you tend to work with your fund administrator on a day-to-day basis. They have more input daily on, you know, your valuation policy and some of the other things from the day-to-day operations of your firm. If that is Uncle Joey in the room next door, that's a big problem. Yes, the auditor can come in, but what we're looking at is how can we quantify transparency? I know it's a bit nebulous, but I think that we've created a system, and it's an evolving system, that we're constantly looking at how can we take those pieces higher that actually speak to our willingness, if you will, to be transparent. Does that make sense?
How do you look at that in the context of, like, for example, a lot of really, really great managers have had really bad years or had spectacular failures, and then they learn from it and go from there. How do you qualify that?
Okay, so if I understand the question correctly then, is how do we put that in the context of managers performing bad or having really bad years? But
Something happened where it was called something huge.
something like 2009 or 2008? Okay. I think that, you know, actually a colleague here, Zivko, mentioned a study that was recently done related to manager selection. And one of the things that he noted in this study was that 54% of the success, if you will, that's found in fund-to-fund managers comes purely from manager selection, not so much from the performance. So if you step back a little bit from performance, and this also goes a little bit to what Rainford talked about, Deutsche Bank recently came out with their survey, again, on what is the most important thing to institutional and high net worth family offices, et cetera. Obviously, it's risk management, as he mentioned, and your operations, and then performance. They have an equal footing, but performance is less so. I mean, if you look at a rising tide or a lowering tide, moving the boats whichever way, I think you have to take those into context. But from an operational perspective, I think that those are intrinsic issues that, one, may not have attributed to that downturn in the fund manager performance. Maybe they did. But that's something that through again, you can't take all the qualitative information and completely make it 100% quantitative, but you can at least remove some of that subjectivity and I think get a better handle on it. Does that answer your question? Okay, thanks.